While property investing may be simple, it's not easy. And that's not a play on words, because many investors end up paying a huge learning fee, or what I sometimes call a stupid tax. It's a fee they didn't expect to pay. And that's because successful property investment comes down to much more than just knowing about what you need, knowing what you can afford, knowing exactly what's available, listening to podcasts. In reality, I guess all property investors end up paying a learning fee of some sort. You either pay the market and end up like most property investors, never building that substantial property portfolio you're looking for, or you pay to get professional advice. In my mind, not taking early advice from professionals means you're going to ultimately end up paying a much greater learning fee or stupid tax. So in today's podcast, I'm going to ask Ken Race, Australia's leading property tax strategist and director of Metropole Wealth Advisory, to share some of the common mistakes he's seen investors make in the hope that we can help you avoid those mistakes. And we're also going to have a quick chat about the new Queensland land tax changes that affect everyone who owns property in Queensland and in other states, and it seems to be scaring a lot of investors. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
I've said it before, I've said it many times, but it bears repeating. As a property investor, you're going to pay for your education. You're either going to pay for it actively seeking out education for yourself and getting professional advice, or you're going to pay for it by making costly mistakes. Unfortunately, the latter path is what most property investors end up doing. So what are some of the more common and costly mistakes that you want to avoid when building a property portfolio? That's what I'm going to ask Ken Race, Australia's leading property tax strategist and director of Metropole Wealth Advisory. Hi, Ken.
Hi, Michael.
Now, Ken, they say a smart person learns from their mistakes, a wise one learns from mistakes of others. So there are a few common property investment blunders I want to discuss with you, along with some strategies that you've used for your clients to avoid making these mistakes. But before we get on to that, I'd like to ask you a question about something that's come up recently that's still evolving, but a lot of, I know your clients have been asking you about, and that's what some people see as a very unfair tax grab that the Queensland state government is considering with regard to land tax for anybody who owns properties not just in Queensland, but owns them interstate as well. What's going on there?
Yeah, I think it's a bit more than considering. They've actually put legislation that commences 30th of June 2023, so next year. So this tax year for most people. So what that legislation does is penalise Queensland landowners with land tax on all their Australian land.
Now, it's actually not land tax that they can charge against other properties, but they change your land tax rate in Queensland if you're lucky enough to own properties elsewhere. Is that right?
Yeah, what they do is they count the value of the land that you have in the other states and put that in towards your land ownership value to then calculate the applicable land tax that you would pay. So you're effectively paying land tax in Queensland on the land you own in those other states as well as the land you own in Queensland.
Right. And I know that's making some people say, well, I'm not going to buy properties in other states, or I'm going to sell up my properties. Now, I see this as a short-term, short-focused way of thinking. By the way, I remember years ago, remember those days when we used to do seminars and go around Australia, and occasionally people would say, hey, I'm thinking of selling my properties because I'm paying too much land tax. And I remember you saying something to them, well, how much of your property's gone up over the last couple of years? So it's a cost of business, land tax, isn't it?
It's certainly a cost of business. And look, for the sophisticated investor, and, sophisticated means if you own one property, you've got at least 500,000, 800,000, $1 million invested in. So you'd want to be sophisticated with that level of investment. Land tax is a cost of doing business, but like any business, you need to seek professional advice on how to manage that investment. And one of those aspects is land tax. And as unfair as that tax grab is in Queensland, I think we've got to come back to the basics and the fundamentals of why people might have bought in Queensland: diversification, rental yield, capacity to borrow, etc., etc. Those fundamentals hopefully are still valid, or they should be. So now it's the tax that I'm going to pay there, how do I manage it? And luckily, there are strategies that you can implement to certainly reduce the amount of that impost, and in some cases even eliminate it. So you've got to understand what the legislation captures and then what it means, and then put in strategies to alleviate that pain.
Now, every time we talk, I mention a disclaimer up front. We have a disclaimer at the end as well. But let's be clear that while you are licensed to give tax advice and you're licensed to give certain financial planning advice, that's not what we're doing today. We're talking in general. And if people want to understand what it means specifically for them, we'll leave a link in the show notes how to speak with you personally about their circumstances, or just go to metropole.com.au and have a look at our wealth advisory section, the company that Ken runs, and you can have a chat with Ken as well. But I know I own property in Queensland, and you advised me. Now, that was before this came, but advised me correctly. So it doesn't affect me. There are ways around it. But even if you do have to pay land tax, Ken, it's actually tax deductible, which is unusual for taxes, isn't it?
Yes, when you pay your income tax, it's certainly not deductible, but land tax is a deductible expense. That certainly, depending on your marginal tax rate, sort of lessens the pain.
Now, of course, there's other changes happening in Queensland as well. The Queensland government is looking at changing the Residential Tenancies Act, which is going to be more in favour of tenants. And I know that this is going to, just looking at what's happened in the past, some people are going to get out of the property market. Some people are going to say, hey, this is just too hard. All it means is that those that remain in the market are going to be in a stronger position to put up rents, and the value of their properties are going to go up because it's going to remain a great asset.
That's right. And I remember when New South Wales brought in similar legislation, albeit a little bit milder, everybody complained. And Victoria picked it up and said, well, that's a good idea. Let's improve the lot for tenants. And now Queensland is doing it. And I think picking up from the other two states, unfortunately, is making it a little bit more favourable to a tenant. But at the end of the day, tenants need somewhere to live. They need a nice place to live. And people who buy investment grade properties in the right location, maintain it, have good property management, then they're the sorts of properties that will attract these tenants and, in a lot of instances, pay for that.
Sure. So we started talking about we're going to be discussing mistakes people make. And again, we don't know your personal circumstances, but I think a mistake some people are going to make over the next little while is make short-term decisions rather than long-term decisions and get out of property or sell property or not buy property because of these legislative changes. The rules are what the rules are. You and I have been around long enough. We've seen GST come in when people said the world is going to end and properties can't go up in value. We've seen capital gains tax disappear and come back again. We've seen all sorts of legislative changes occur. And over the time, the value of well-located properties has just kept doubling more or less every 10 years.
That's right. And we can't get away from the inevitable. We don't produce more land. And councils are making it more and more difficult for high-rise. because of the planning approvals, the cost of those high rises due to safety issues, etc., is going up and up and up. So there is this continual march, I think. It's scarcity. It's a scarce asset, land.
And people are going to want to live in the same sort of special locations. Now, let's look at some other common mistakes people make. Maybe we can break it down into a couple of the areas that you and your team at Metropole Wealth Advisory specialise in. Now, we had a chat a little while ago about estate planning, and so if people are interested in that, just go back to wherever you listen to this podcast and have a look at have a listen, I should say, to one of the chats that Ken and I had about estate planning. But what are the common mistakes that you're seeing people make in that arena?
Yeah, and maybe to summarise, what we're seeing over the next, 15 years, depending on which article you read, is trillions. That's with a T. Trillions of dollars worth of wealth being transferred from one generation to the next.
The baby boomers and their parents, a few of them are still alive, own about 60% of all the properties in Australia. Now, that makes sense, Ken, because we've been around longer and had a chance to own properties and pay it off. So if the property market is worth $10 trillion, as the Australian Bureau of Statistics tells us it is, then our generation, yours and mine, in general owns maybe 6 trillion of that. And I'm not planning to go anywhere anytime soon, but over the next 10, 15, 20, 30 years, yes, that's going to get passed on by the baby boomers to their younger generations. So that is a huge amount of wealth transfer.
Yeah. Well, Michael, hopefully at least 30 years. But getting back to the topic, the way you pass down that wealth is very important. So we should always be asking ourselves 3 questions. Who will get what and how they will get it? And unfortunately, 50 to 70% of people don't actually have a will. That means they die in what they call intestate. And that means in most cases, the courts will decide. And I guarantee you that's not going to be a cheap exercise. That's going to be a very lengthy and very expensive exercise, even if everybody agrees, because you still got to go to court and get it approved. So it's imperative, that's my word, of course, so that's what I feel. It's imperative that we have written instructions on how to hand down that wealth. And out of the people that have a will, I'm surprised that when I describe the contents of that will and the implications of the distributions, almost everyone is surprised that that's not what they wanted. And a common theme is to pass it down to my children safely. I don't know what people have against in-laws, but they want their children to get the money and their children to keep it, not
stay in the bloodline, in other words.
That's it, and not go out in a divorce. Or if you distribute money to young children, that's invested. The income is taxed at a rate starting at 66%, falling down to 45. So there are other issues, such as it goes to somebody who's in a litigious profession or does something wrong and is then litigated. So in the majority of cases, the passing of those estates, no asset protection, family law court issues, no flexibility to manage tax, and the 66% minus tax. So that means you need a different how.
So the typical will, and definitely not the ones you get online for $20 or whatever, or even the normal suburban solicitor, isn't going to be able to cover that. And that's why you need the holistic approach that you and your team at Metropole Wealth Advisory give. Can you give us some examples, maybe some case studies, some clients that it could bring this story home?
Yeah. So recently saw a couple of clients. One went to the trouble of purchasing a property in their spouse's name because he was in a litigious profession. And unfortunately, the spouse passed away and the will now put the property in his name. The exact thing they were trying to avoid. Whereas a properly structured will could have still given him access to the property and that main residence exemption for capital gains and land tax in a much safer way without putting that property at risk.
So I guess what happened was they only thought one step forward rather than multiple steps forward.
Not what happens on the second side, on the second step.
Sure. And that also occurs when you're thinking about your children and grandchildren also, isn't it? So
that's right.
I'm at this stage where my children are adults and reasonably well off. So I'm wanting to make sure my grandchildren get things.
One thing that sticks in mind is I went to a seminar, maybe 15 years ago, and a solicitor was talking about this subject, and he coined the phrase, kill the relatives. Now, not literally, metaphorically, and it's always stuck in my mind. It's when you say I wanted to go to A, you've got to think what happens when A goes, and then it goes to B, what happens to B? Now, the other benefit of doing that exercise is when you go to the lawyer to produce that document, it's going to be a much shorter session with lawyers and therefore bring the cost down because the way lawyers work, obviously, is on time. And if they've got to explain these things and drag it out of you.
Right. Okay, you said you had two clients you wanted to discuss.
The other had benefited from his father transferring, quite a sizable portion of his estate to his son, as the wife was well taken care of. So father was going to give to the son and exclude the wife. The wife had her own considerable assets. So the son came to us as a new client trying to protect these assets in a divorce. He was going through a divorce, and he was surprised to hear from his lawyer that those assets that his father had passed down were now subject to the family law court, and they were brought in and were going to be divvied up. And that's certainly not what father wanted, certainly not what son wants. But again, a correctly structured and worded will would have safeguarded those assets, and therefore, in the majority of cases, they would not have been available to a divorcing spouse.
So it's interesting. Lawyers typically don't take into account other factors, taxation, the impact of the next generation, flexibility. So it's important to ensure all that happens. And again, for those who didn't listen to that recent episode where we discussed estate planning, it actually requires more than the will, because a will doesn't cover things like assets in that are not in your name, such as in trusts or maybe superannuation.
Super is the big one, yes.
So there are solutions you can have, but the bottom line is you've got to plan your estate, or you've got to do estate planning, I guess is the right way of saying it, long before you think you need it. I think the last couple of years has shown us we can have all sorts of health problems and issues coming out of the blue. So if people are interested in understanding what their options are, I know you provide a specific estate planning service. How does what you do differ from if you go to the normal suburban solicitor?
So I think when you go to a suburban solicitor, they would produce a will. So to me, that is not estate planning. Estate planning takes into account many things, one of which is your will. And it looks at these what ifs, it looks at it more holistically. It takes into account taxation. There's a client that when I saw them, they were going to pass a sizable amount of money out of their super. And the problem was it was going to what is effectively an adult child, a non-tax dependent, and that would have been taxed at 15% in the child's hands. And because there was a little bit of life insurance in there, that life insurance would have been taxed at 30%. So understanding where the money's coming from and which buckets of money goes to who can greatly reduce the family's future tax bill. So you've got to take all that into account, asset protection. So it's not just a will. When I die, it'll go to my spouse, and when my spouse dies, it'll go to my children. Particularly nowadays when we have blended families, people have been married 2, 3, 4 times. So there's special emphasis that has to be put on protecting those assets to go to the people that you choose for those assets to go to in a way that reduces the capacity for them to put in objections.
So, Ken, we're going through some of the common mistakes that you see clients who come to you at Metropole Wealth Advisory having made. And I know part of your job is to fix their problems. Some of them is to prevent problems in the future and to maximize their position. Now, I know that many of the clients that we see at Metropole use structures to own their assets, including as part of the estate planning process. And I know there are other people out there and other popular podcasts who say, no, just keep it simple. Don't do that. The only reason an accountant would tell you to set up a trust is so that he can get more money from you every year. Well, you don't do accounting, even though you are an accountant, you don't do the annual returns. So that's not the reason at all. Why would you suggest people have a look at what structures they own assets in?
I think when you're looking at what name to put on the purchase of an asset, and let's call it property now, but it relates equally to any asset. You need to consider a number of things, such as your estate planning, asset protection, tax management, keeping your taxes as low as possible, and land tax. And you need to prioritize those and overlay your capacity to borrow. So what is your borrowing capacity, which bank you're going to go through, how are they going to manage that process. And that will then determine the buying structure. So a lot of people basically skip all that and just say, I'll keep it simple and buy it in my name.
Now, interestingly, once a year we get together with a lot of our high net worth clients at Wealth Retreat, and when you speak to them, no one owns anything in their own names. And similarly, I know a lot of our clients who don't go to Wealth Retreat, who own very substantial property portfolios, our clients at Metropole, they similarly have got this right sort of advice. So if that's what the wealthy people do, take a leaf out of their book. Don't listen to those who tell you it's just making things more complicated and expensive.
Yeah, and look, with all due respect to a lot of the advisors and professionals out there, they're working in a space that captures, can I say, 70% of people? And they focus their efforts on what do we do for those 70% of people.
Okay, that makes sense. You don't want to be in that group, the common crowd, do you?
No, and as such, you've got to work in that 30% space, which is all very legitimate, all absolutely legal, but it's at a technical level slightly higher than the 70% group. So while the 70% group are getting it right, they're not doing the best.
I hear what you say. Interestingly, one of the things I see with clients is often they've outgrown their accountant. So the accountant's advice may have been appropriate for them when they first started off, but as they build their businesses or property portfolios, often they know more about what's going on than their accountant does because they listen to podcasts, they listen to you, they read your blogs. So it's often difficult for them because you've got a special relationship with your accountant, it's often difficult for them to move or to take advice from others.
That's right. And that's why that service that we offer highlights any deficiencies, corrective measures, how to do things slightly different. And then we work with that client's accountant to make sure that it's implemented correctly. So in a medical analogy, we're the specialist and the accountant's the GP. So there's that working relationship. So the client actually does the day-to-day stuff through the accountant with the oversight of the specialist to make sure that it's being done correctly and for the client's, can I say, best outcomes.
Sure. So I know you and we offer a number of different services, and sometimes it's just looking at the structures, sometimes it's looking at estate planning, sometimes it's actually a more detailed general approach, which most people need. And there's also for higher net worth clients who are busy business people, successful property investors, you actually have an ongoing program where people have regular contact with you. So while they still have their accountants and solicitors, etc., you're there holding their hands and making sure that they've got access to you. And people seem to like that, Ken.
Yeah, because it is that holistic view of things that takes into account the many other different aspects. And the second thing is, I think it allows people to sometimes get a second opinion without being threatening. And it also allows them to get a bit of clarity, because when we produce a plan for clients, it's focused on giving them clarity of where they're going and what they need to do to get there as it relates to tax, asset protection, trusts, estate planning. That's that whole circle of things that you've got to do to actually achieve, can I say, a more modern wealth creation plan, not hit or miss. Everything is aimed at giving you speed and direction.
Okay, so let's look at some of the mistakes people make with structuring.
These are very, very common mistakes I see all the time. People, even if they buy in their own name, there's big issues in land tax because of the way the various governments treat land tax when people buy individually or jointly. So in a lot of instances, it's actually better not to buy with a spouse. It's better to use one name and then look at the finance of how to use the spouse's income, because that can, depending on the state you invest in, just doing that slight difference can almost halve your land tax bill. And that's big dollars.
So again, we talked about before, investing in professional advice in the future to actually, it's an investment, because what it's going to do is save you a lot more in the long term.
That's right. We had a new client who came to see us. They bought a property in a family trust. It was negatively geared because they had bought a good investment grade property. They were chasing the capital growth. And a year and a half later, they bought that trust off a solicitor. A year and a half later, their accountant says you can't claim the negative gearing because that type of trust doesn't allow you to claim negative gearing against PAYG. But we were able to find a solution that actually allowed them to then get those tax deductions against their PAYG. We had a new client who came in and having heard and read different things about us and just said, can you please review what I've got? I've got a trust deed. I think it's the right one to get the negative gearing. And it was. But unfortunately, the accountant hadn't set it up correctly. And therefore, all those potential tax benefits that the client would have got would have been lost, and if the ATO had done an audit on them. So we corrected those mistakes to actually now make it a viable structure that would pass ATO muster. And some of those issues are more legal than they are accounting or tax, but the ATO wins over 50% of their court cases, not because something is illegal, but because the person didn't dot the I's and cross the T's.
Gee, yeah. So again, I think it's come through a couple of times that accountants think about their area and solicitors, legal people look at different areas, and they seem to almost be speaking different languages, Ken.
That's right. They work in their silos because that's what they do. You know, I'm an accountant, and who was my client when I was practicing accountant? Look, I hate to say it wasn't the client in front of me. It was the ATO. And therefore, you do everything to make sure that your license isn't a jeopardy. And that's why most people work in that 70% band. So you need someone who thinks not outside of the square, outside of the box. It's create a bigger box and then move to the outer edges. So it's taking into account how one thing affects the other. You know, sometimes they talk about unintended consequences. Well, that's what we see with a lot of clients when they do something. There is unintended consequences somewhere else. And they don't go to two different professionals to seek advice. So what we can do is that holistic view, holistic approach that then looks at all those other issues.
Okay. Well, again, if people want to find out more, go to metropole.com.au and look at the wealth advisory services. So, Ken, I keep hearing that people come to you maybe a little bit late. They've already made their decision. They've purchased their property. They've got their will in place. They're getting into trouble with the tax department, or they feel they're paying too much tax. And boy, if I could only have changed it beforehand. What advice would you give to people?
Look, two big pieces of advice. You got to keep the end in mind when you do things, and you got to go and seek advice, can I say, before you need it. It's too late to go to a surgeon when, something bad has happened to you. You need that preventative medication. And it's the same for this. So what I see a lot is, as the older generation are getting older, Alzheimer's, those sorts of things are coming in. They've done the right thing by getting powers of attorney in place so they can sign documents for mum or dad. But the biggest mistake I see is they haven't spoken to mum or dad at that time and said, let's review how your will has been structured. Because unfortunately, once you do go into that state of dementia and you don't have that competency, you can't change your will. And the person who has your power of attorney can't change it. They can't either. So when I talk to clients about what they should be doing, and they say, oh, geez, that's what mum and dad should do, it's too late because mum and dad now don't have the competency to do that will. So when you're looking at setting up powers of attorney, because the parent has to have competency, obviously, at that stage, you've got to ask that second question, that third question. So peek over the hill and ask that second question, which doesn't normally come to mind.
I guess it's interesting over your journey as a property investor, business person, just the journey in life, your circumstances change, your needs change, the sort of advice you need changes. So while you may well have set up something a while ago, maybe it's not relevant anymore.
That's right. So that's why you've got to update it. Laws change, and circumstances change, big life events change. So you've got to look at all those things. And
well, I know you've done that personally for me with my superannuation fund, which was set up many, many years ago. But boy, have things changed in that time with trusts as directors of trusts and beneficiaries. So it is a moving feast. And this is partly what you keep talking about, treating it like a business. It can't just be static. It's not just set and forget, is it?
No, because life isn't. And this is what all these things reflect your life. And therefore, as your life changes, you've got to look at things, but unfortunately there's these outside influences, government legislation, what else is happening around the world. Now, one of the things I think we do very well is when we set up a plan for someone, we create some flexibility in there to allow for these changes. So therefore it's not, I'm going to have to go from A to B and it's going to be a big capital gains tax trigger.
Any other client stories? I like hearing about these.
Yeah, look, just on that, when we were talking about that enduring power of attorney, one client many years ago, it really resonates. I was talking to them. He was self-employed, high income earner, and I said they don't have income protection insurance. So if something happened to them, so this is, again, just general comments because I don't know the audience's specific circumstances, but in a general sense. But this client's story was, I said, they've got to get income protection. They should seek that advice, and we directed them to somebody. Now, initially, the client thought it was too expensive. And can I say I persisted with them because I'd got to know them. There was a sort of a personal relationship. And in the end, the wife said, look, Ken, it's too expensive, but I trust you. I'll do what you say. And unfortunately, a year later, the husband came down with MS and basically couldn't work the last 25 years of his life. But the income protection kicked in and he's got an income now, until he's 75 years old. And I don't know what made me happier, that at least the family financially is okay, or that she trusted me enough. So we build trust with people by doing different things. And as they see the results, I think they can see the value.
Sure. Well, there's lots more case studies we could talk about and lots more mistakes. And I'd like to continue on in our podcast next month talking about those. But I think the lesson from all this is you are going to make mistakes. We all do. You can either learn from your own mistakes, which are expensive and hurtful, or you can learn from others' mistakes. And that's why we talk about this. I guess it's all the successful people who write books and talk about their success. Failures don't end up writing books or conducting webinars or seminars, do they, Ken? But you can often learn more from those.
That's right. You don't see the ad for, come and see me and I'll tell you all the mistakes I made. But like you said, that's probably the ones to go and see, because at least you know what to avoid. But then you don't know what to do instead or in place.
You need a combination of both, don't you? So thanks for sharing those case studies and thanks for sharing those mistakes. And boy, there are a lot of mistakes that one can make. But today, with the advice available, you shouldn't make it. So my suggestion is, if you're considering looking at your structures, seeing if you are going to be able to pass your wealth on to the next generation and the generation after that, or if you're just wanting general advice about, are you doing things the right way, go to metropole.com.au, click on the Wealth Advisory tab and organise a time to catch up with Ken, or I'll leave a link in the show notes. And I look forward to catching up with you next month. And can we continue on and do some more common mistakes then, Ken?
Absolutely, Michael. Absolutely.
Great. Thanks a lot, Ken. Bye.
Thank you. Thanks, Michael.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I'd like to share with you the concept that you have to break something to have a breakthrough. You see, I found most changes in life come through adversity. Most breakthroughs come out of having to break something. To have a breakthrough, as I said, you have to break something. If you look at the times in your life where you had the greatest awareness or the greatest shift, it probably came out of some pain. I know that's the case with me. Look, in your case, maybe somebody died, somebody who was close to you. Maybe you had a breakup that felt like your heart had been ripped out of your chest. Maybe there was some other traumatic life event. Most shifts that people have, most of the significant shifts people have, come out of painful areas of their life. The areas of their life that work and areas of their life that don't work. And most lessons and most breakthroughs come out of an area of your life that just hasn't worked, and you're forced to face it and then make a change. Let's be frank, you're not going to go through life without difficult things happening. But if you think about it differently, it will work better for you. Because in my mind, it's all fertilizer. It's all how you use it. There's plenty of fertilizer in the world to grow beautiful things, or you can focus on how things could just suck and never grow. If you do the latter, you won't be able to have any of the breakthroughs because you're looking at it through a distorted lens. It's your choice. You can make a choice to grow. If you choose to grow, just to come so far, what lessons can you learn out of this so that you can change? Because you've heard me say it before, nothing will change unless you do. The outside world won't change unless you do. So you're just going to have to break something before you have that big breakthrough. I hope you got some benefit from my chat today, and if you did, and you know somebody else who'd benefit, please do them a favour and tell them about the Michael Yardney podcast. You'd be doing me a favour as well in my quest to make as many people as financially literate as possible. Now, it's actually really easy. If you've got an Apple phone, there's 3 little buttons at the bottom of Apple Podcasts. Just press the 3 little dots, and there's a share button, and there's a similar share button on Spotify or all the other podcast apps as well. And of course, you can tell the world by leaving a review. Now, I'll be back again real soon, but you can catch catch me in between shows on social media. Just look for Michael Yardney. And I'd love you to be part of my private Facebook group where every day I leave a tip, some charts, something different that I won't leave elsewhere. Go to Facebook and look for the Property Update Facebook group. And as my way of saying thank you, if you're a new subscriber to this show, go to podcastbonus.com.au, and I've got a bundle of ebooks and reports for you. Now, I've mentioned a whole lot of things, but there'll be some links in the show notes for you, so join me on social media or get those bonuses. As I said, I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?